It began like any other ordinary night in global finance. Trading floors had gone quiet, office lights were dimmed, and most people assumed the system was running on autopilot, as it always did. There were no explosions on television, no emergency speeches from heads of state, no visible sign that anything was wrong. Yet behind the screens, something far more fragile than money itself was quietly breaking. Trust between banks. Modern banking does not run on vaults full of cash. It runs on promises. Every night, banks lend to each other, borrow from each other, and settle obligations that accumulated during the day. These are not long-term loans. Many of them last only hours. A bank with excess reserves lends overnight to another bank that needs liquidity to meet its obligations by morning. By sunrise, the loan is repaid with a small amount of interest, and the cycle repeats. This process happens across borders, time zones, and currencies, forming the invisible plumbing of the global payment system. What keeps this machinery running is not collateral alone, and not regulation alone, but the assumption that counterparties will perform. A bank sends funds tonight because it believes a receiving bank will still be solvent tomorrow morning. This belief is rarely questioned during normal times. It is embedded so deeply in the system that most participants stop noticing it altogether. That night, the assumption cracked. It did not happen all at once. There was no single announcement saying, "Trust is gone." Instead, it appeared as hesitation. One bank decided not to roll over an overnight loan. Another demanded higher interest for the same transaction it had priced cheaply just days before. A third quietly withdrew from the interbank market altogether, choosing to sit on cash rather than lend it out. These decisions were rational on an individual level, but collectively they formed a pattern that was impossible to ignore. Interbank interest rates began to rise sharply. The cost of borrowing overnight money, which normally moves in tiny increments, suddenly spiked. This was not because cash had disappeared from the system. There was plenty of money on balance sheets. The problem was that no one wanted to part with it, even temporarily. Cash had become more valuable than yield. Liquidity was being hoarded. At the core of this behavior was fear, but not the kind most people imagine. Banks were not afraid of losses in the abstract. They were afraid of uncertainty. They no longer trusted the information they had about each other's balance sheets. Financial statements are published quarterly. Market rumors move in minutes. When stress enters the system, yesterday's numbers feel meaningless. A bank might look healthy on paper, but what if hidden losses existed off the balance sheet? What if exposure to a collapsing asset class had not yet been disclosed? What if tomorrow morning brought news that made repayment impossible? Once these questions appear, trust evaporates faster than capital. The interbank market is often described as the heart of the financial system, but at night it functions more like its nervous system. Signals travel quickly. When one institution pulls back, others notice. No bank wants to be the last one lending to a counterparty that fails hours later. In such an environment, caution spreads contagiously. Lending dries up not because banks want to punish each other, but because survival instincts take over. This is where the paradox of banking becomes visible. Individually prudent behavior can produce collectively catastrophic outcomes. By refusing to lend overnight, a bank protects itself from counterparty risk. But if enough banks do this simultaneously, the entire payment system begins to seize. Transactions that depend on short-term funding cannot be completed. Clearing obligations pile up. What looked like a liquidity preference becomes a systemic threat. To understand why this matters, it is important to grasp what payment actually means in modern finance. When a large bank transfers money to another institution, physical cash does not move. Instead, reserves are shifted across accounts at central banks, and claims are updated across multiple ledgers. Many of these movements are synchronized through clearing systems that assume smooth, continuous settlement. If one part of the chain hesitates, the delay propagates outward. That night, the hesitation grew. Banks began to question not just weaker institutions, but strong ones as well. Reputation, size, and history no longer guaranteed confidence. Even banks considered too big to fail found counterparties reluctant to extend overnight credit, without additional guarantees. This was a critical psychological turning point. When trust disappears at the top of the system, there is no safe reference point left. What made the situation especially dangerous was its timing. Nighttime is when global finance overlaps. Asia is winding down, Europe is asleep, and North America is settling the previous day's transactions. Liquidity management during these hours is essential. If overnight funding fails, obligations cannot be met when markets reopen. A problem that starts in darkness can become a visible crisis by morning. Yet for hours, the public remained unaware. ATMs still worked. Credit cards were still accepted. Online banking portals showed familiar balances. The system was not off. It was frozen internally, like water on the verge of turning to ice. From the outside, everything appeared normal. Inside, banks were staring at screens, watching rates climb, offers vanish, and confidence dissolve. The most unsettling aspect of the night was how quickly it unfolded. Trust that had taken decades to build was questioned in a matter of hours. This exposed a truth that rarely enters public discussion. The stability of the financial system is not guaranteed by law alone. Regulations define behavior, but they cannot force belief. Contracts specify obligations, but they cannot eliminate doubt about future solvency. At some point, the system relies on collective faith that tomorrow will resemble today. That faith was gone. By the time policymakers began to grasp the scale of the problem, the damage to trust had already been done. The interbank market, normally invisible and taken for granted, had become the focal point of fear. The question was no longer whether some banks might fail, but whether the system that allowed banks to pay each other at all could continue functioning. If banks could not trust banks, the implications were profound. Every corporate payroll, every international shipment, every government transaction ultimately depended on this web of overnight confidence. The night revealed something unsettling. The global economy was not held together by money, but by belief. And belief, once shaken, does not obey schedules. As dawn approached in different parts of the world, the system stood at a fragile threshold. Either trust would be restored through extraordinary measures, or the freeze would harden into something far more visible and destructive. The night had shown how close the world came to discovering what happens when the promises behind money stop flowing. To understand why the world came so close to a standstill that night, it helps to strip away the abstraction and look at how payments actually move. Most people imagine a transfer of money as something direct. One account goes down, another goes up, and the transaction is finished. In reality, especially at the scale of international finance, a single payment passes through a layered system of institutions, each one relying on the next to do what it promised. Start with a simple example. A company in Germany paying a supplier in South Korea. The German firm instructs its commercial bank to send the funds. That bank likely does not have a direct relationship with the Korean bank. Instead, it uses a correspondent bank, often a large global institution, that holds accounts for both sides. The payment message travels through a messaging system, while the actual settlement happens through reserve accounts held at central banks or through international clearing systems. Each step is a claim, not a physical transfer of cash. This process works because timing is assumed to be predictable. Banks do not wait for every leg of a transaction to settle in cash before moving on to the next. They extend short-term credit to each other, smoothing the flow of payments across time zones. A bank might release funds in Europe based on the expectation that it will receive offsetting funds in New York hours later. This is where overnight and intraday liquidity becomes critical. Without it, the chain breaks. At the center of the system sit clearing houses and settlement platforms. These institutions net out thousands or millions of transactions, reducing the amount of money that actually needs to move. Netting is efficient, but it also concentrates risk. If one participant cannot meet its obligation at the end of the day, the clearinghouse must either absorb a shock or force others to cover the gap. This is manageable when defaults are rare and predictable. It becomes dangerous when trust evaporates across the board. On the night banks pulled back from each other, the first strain appeared in these clearing mechanisms. Institutions that normally relied on short-term borrowing to fund their settlement positions suddenly found that funding unavailable. They still had assets, but assets are not the same as liquidity. A bond or a loan may be valuable, but it cannot be used to settle a payment due in the next hour unless someone is willing to lend against it. As banks grew uncertain about their counterparties, they stopped treating assets as interchangeable with cash. Collateral that had been accepted routinely was now questioned. Haircuts increased. In some cases, collateral was rejected altogether. This meant that even banks willing to borrow could not do so on acceptable terms. The market was not signaling that money was scarce. It was signaling that trust was. One of the clearest indicators of stress was the behavior of short-term funding rates. In calm periods, the difference between a risk-free rate and an interbank lending rate is small. That spread reflects a modest premium for credit risk. During the freeze, the spread widened dramatically. This was not driven by new information about specific failures, but by a generalized fear that no balance sheet could be taken at face value. When risk cannot be priced, the market's default response is to withdraw. As a result, payments that normally cleared smoothly began to slow. Banks delayed outgoing transfers to preserve liquidity. They waited for incoming funds before releasing their own. This cautious behavior made sense individually, but it created feedback loops. Delays on one side caused delays on another. Soon, the system was operating on a payment versus payment mentality, where nothing moved unless everything moved. In a global network, that is a recipe for gridlock. The danger was not that payments stopped instantly, but that they became uncertain. Corporations could not be sure when funds would arrive. Financial institutions could not be sure whether their counterparties would honor commitments by the end of the day. Even a delay of a few hours mattered, because many obligations are legally and operationally time-sensitive. Missing a settlement window can trigger penalties, margin calls, or technical defaults, even if the underlying institution remains solvent. This is where the concept of a soft freeze becomes important. Unlike a power outage, where systems go dark, a financial freeze is subtle. Screens stay on. Transactions are still possible, but volumes shrink, buffers grow, and confidence erodes. The system continues to function, but in a constrained defensive mode. The longer the state persists, the more likely it is to tip into outright failure. Historical precedents offer clear warnings. During the 2008 financial crisis, for example, the collapse of trust in short-term funding markets led to a near total breakdown of interbank lending. Even institutions with strong capital positions found themselves unable to borrow overnight. Central banks later disclosed that without emergency facilities, major payment systems would have failed to settle on time. The public never saw this moment, but it came dangerously close. That night followed the same logic. Banks were not reacting to a single event, but to the realization that the system itself depended on assumptions that could no longer be taken for granted. If every payment depends on someone else extending credit, and no one is willing to do so, then money, as a medium of exchange, loses its fluidity. It becomes trapped in silos, locked behind balance sheets. What made the situation especially precarious was the global nature of the freeze. Payment systems do not operate in isolation. A disruption in one major currency can spill over into others through foreign exchange swaps and cross-border settlements. When trust disappears in one market, it forces institutions to pull back everywhere. Liquidity becomes fragmented along national and institutional lines, undermining the idea of a unified global system. By the time policymakers fully appreciated how close the system was to stalling, the mechanics of payment had already revealed a hard truth. The world's financial infrastructure was not designed to function without trust. It was designed to economize on cash by relying on confidence. Remove that confidence, even briefly, and the machinery begins to grind. The night showed that payments do not fail because money vanishes, but because belief does. And once belief is questioned at every link in the chain, even the most sophisticated financial architecture can find itself one missed settlement away from paralysis. The freeze did not announce itself with sirens or close bank doors. Instead, its effects seeped outward quietly, touching different parts of the economy at different speeds. By the time most people sensed that something was wrong, the system had already been operating under strain for hours. This was not a collapse anyone could photograph. It was a disruption you could only infer from missed payments, delayed confirmations, and phone calls that suddenly went unanswered. Large corporations were among the first to feel it. Multinational firms managed cash across dozens of banks and currencies, relying on precise timing to fund payrolls, sell invoices, and roll over short-term debt. On paper, many of these companies were cash-rich. In practice, that cash was scattered across jurisdictions and institutions. When banks hesitated to move funds, treasurers found themselves unable to consolidate liquidity. A subsidiary might be flush with money in one country, while another unit faced a shortfall elsewhere, with no easy way to bridge the gap overnight. This created a peculiar form of financial stress. Companies that were solvent became operationally constrained. Payments to suppliers were postponed not because of insolvency, but because settlement could not be guaranteed. Credit lines that had always been available were suddenly under review. Banks did not cancel facilities outright. They slowed approvals, added conditions, and demanded more collateral. Each small friction added to a sense that the ground rules had changed. For smaller businesses, the impact was sharper and more immediate. Unlike large corporations, small firms operate with thin buffers. They depend on predictable cash inflows to meet daily expenses. A delayed payment can mean a missed payroll or an unpaid invoice. When banks slowed transfers and counterparties grew cautious, these delays multiplied. Suppliers waited long to get paid, so they delayed their own payments in turn. What began as a financial hesitation at the top cascaded into the real economy through the most basic mechanism, cash flow. Yet even as these stresses mounted, there was no visible panic. Shops stayed open. Offices functioned. Consumers swiped cards and withdrew cash as usual. This apparent normality was deceptive. The system was in what could be called a frozen flow state. Money existed, but it was not circulating freely. The difference between a healthy economy and a stressed one was no longer the amount of money, but the speed at which it moved. Banks themselves were acutely aware of this fragility. Inside Treasury departments, managers monitored intraday positions minute by minute. They prioritized internal transfers, hoarded reserves, and delayed non-essential payments. These actions were defensive, designed to ensure survival if conditions worsened. But they also reinforced the freeze. Each bank's effort to protect itself made the system more brittle. The public-facing side of banking remained calm, largely because of buffers built into the system. ATMs are stocked in advance. Card networks have contingency arrangements. Many retail transactions settle on a delayed basis, masking immediate stress. This lag creates an illusion of stability. By the time consumers notice disruptions, the problem has usually grown severe. That night, the lag worked both ways. It prevented panic, but it also delayed awareness of how close the system was to breaking. The most dangerous aspect of this kind of freeze is its invisibility. When factories stop or shelves empty, the cause is obvious. When payment systems strain, the signals are abstract. A transaction pending, a transfer under review, a settlement delayed due to technical reasons. Each phrase sounds benign. Together, they indicate a system operating under duress. Historically, crises that unfold this way are among the hardest to manage. Policymakers respond to what they can measure, and trust is not easily quantified. Capital ratios may look adequate. Liquidity coverage metrics may appear compliant. Yet the lived reality inside institutions can be very different. Fear does not show up neatly in regulatory filings. The freeze also highlighted how interconnected modern economies are. A delay in one region quickly affected others through supply chains and financial links. A manufacturer waiting for payment delayed shipping. A logistics firm postponed fuel purchases. A retailer deferred inventory restocking. None of these actions made headlines, but together they represented a slowing of economic metabolism. Perhaps the most unsettling realization was that this was not caused by physical damage or legal prohibition. No law had been passed to stop payments. No infrastructure had been destroyed. The constraint was psychological and institutional. Banks were still able to pay, but they were no longer willing to take the risk of doing so without guarantees. In effect, the system had imposed its own form of rationing. Comparisons to wartime disruptions missed the point. War destroys capacity. This freeze constrained coordination. The factories, ports, and offices were all still there. What faltered was a connective tissue that allowed them to function together. Without reliable settlement, contracts lose meaning. Without timely payment, production slows regardless of demand. As hours passed, the pressure built not through dramatic events, but through accumulation. Each delayed payment increased uncertainty. Each unanswered request eroded confidence further. The longer the freeze persisted, the greater the risk that a temporary liquidity problem would turn into a solvency crisis, as missed obligations triggered penalties and defaults. By the time dawn approached in major financial centers, the strain was evident to those closest to the system. The invisible freeze had not yet become a public crisis, but was already shaping decisions across the economy. The question was no longer whether the system was under stress, but how long it could operate in this state before something snapped. When the response finally came, it did not arrive as a single dramatic intervention, but as a coordinated realization among central banks that the problem was no longer about individual institutions. It was about the survival of the payment system itself. Once trust between banks collapses, only one actor remains that everyone can trust by definition: the central bank. Not because it is morally superior, but because it alone can create liquidity without depending on anyone else's promise. The first step was to make it clear that money would not run out. Central banks signaled, sometimes explicitly and sometimes through action, that they were prepared to lend in whatever size was necessary to stabilize overnight funding markets. This was a psychological move as much as a financial one. The message was simple: if banks would not lend to each other, the central bank would lend to all of them. By positioning themselves as a lender of last resort, central banks stepped into the void left by broken trust. Emergency lending facilities were expanded or reactivated. Terms that had once been considered extraordinary became routine. Collateral rules were relaxed. Assets that had been viewed as risky only days earlier were suddenly acceptable in exchange for central bank funds. This was not because those assets had become safer overnight, but because the priority had shifted. Preventing payment failure took precedence over concerns about moral hazard. One of the most critical tools deployed was the use of currency swap lines between central banks. These arrangements allowed central banks to provide foreign currency liquidity to their domestic banks without relying on private markets. A bank that needed dollars, for example, could obtain them through its local central bank, which in turn accessed dollars via a swap line with the U.S. Federal Reserve. This mechanism bypassed the frozen interbank market entirely, restoring the ability to settle cross-border obligations. Repo operations also played a central role. By offering to buy securities with an agreement to sell them back later, central banks injected short-term liquidity directly into the system. The scale of these operations mattered. By committing to conduct them in unlimited amounts if necessary, central banks removed the fear that access would be rationed. When institutions believe liquidity might be capped, they rush to secure it. When they believe it will be abundant, the urgency diminishes. Gradually, overnight rates began to ease, not because banks suddenly trusted each other again, but because they no longer needed to. The presence of a credible backstop changed behavior. Banks knew they could meet their obligations even if private funding remained scarce. This reduced the incentive to hoard cash. Payments that had been delayed started to move. Clearing systems caught up on backlogs. The freeze softened. From the outside, it looked as if the crisis had been averted. The public never experienced widespread payment failures. There were no mass ATM shutdowns, no days when salaries could not be paid. In that sense, the intervention succeeded. But it also marked a turning point in how the financial system would function going forward. By stepping in so decisively, central banks did more than restore liquidity. They replaced a market-based trust mechanism with an institutional one. Banks learn that when confidence breaks down, the central bank will intervene to keep the system running. This knowledge altered incentives. The interbank market, once a space where risk was priced and managed collectively, became less central. Private trust was no longer the only glue holding the system together. The long-term consequences of this shift are complex. On one hand, the system became more resilient to sudden freezes. On the other, it became more dependent on central bank support. The boundary between emergency measures and normal operations blurred. Tools designed for crises were kept in place, ready to be deployed at the first sign of stress. What had been temporary became structural. This raised uncomfortable questions. If markets function only because a central authority stands ready to intervene, how much trust truly exists between private institutions? And if that trust is eroded permanently, what happens the next time fear spreads faster than policy responses? The night when banks froze the world revealed a fundamental truth about modern finance. Stability does not come from the absence of risk, but from the management of confidence. When confidence fails, systems that appear solid can seize in hours. Central banks can restore motion, but they cannot recreate the kind of trust that once existed organically between institutions. The system moved forward after that night, but it was not the same system. Payments flowed again, yet they did so under a new assumption that behind every private promise stands a public backstop. This assumption kept the machinery running, but it also changed the nature of responsibility and risk. In the end, the world did not stop. The freeze was reversed before it became visible to most people. But the lesson remained, quietly embedded in the architecture of global finance. Trust can vanish overnight. When it does, only institutions with the power to create belief can hold the system together. And that power, once exercised, is rarely forgotten.